Hall & Wilcox acknowledges the traditional custodians of the lands on which this podcast is recorded. We pay our respects to their elders, past and present, and to all First Nations people joining us today.
Hi, and welcome to our latest Doing Business in Australia podcast episode. At Hall & Wilcox, we work with both Australian and international clients, and we support our clients with their global opportunities. We have experts within the firm who do cross-border work in many jurisdictions, including the UK, Europe, China, Southeast Asia, Japan, India, the US, and Canada. My name's Mark Dunphy, and I'm delighted to be the host of this episode, where we're going to put the spotlight on the Southeast Asian market. To join me in discussion today is Ed Payton, who's the head of our Southeast Asian practice. Welcome, Ed. I'd like you to start, if you would, with a high-level overview of the importance of the Southeast Asian market to Australia and vice versa.
Thanks, and good to be here. So ASEAN is Australia's second largest regional trading partner. It's ahead of Japan and the US. Of the ASEAN countries, the most two-way trade is with Singapore, and in the next grouping sits Thailand, Malaysia, and Indonesia, closely followed by Vietnam. In terms of inbound investment into Australia, Singapore is the standout.
Right. Well, let's dig a bit deeper into some specific issues. I want to ask you about regulation in Australia that affects foreign investment, in particular the Foreign Investment Review Board, or FIRB, but also the new merger clearance laws that come into effect on the 1st of January of next year and how these might affect inbound transactions. Let's start with FIRB.
So Australia's foreign investment laws are administered by Treasury and supported by the Foreign Investment Review Board, or FIRB. The relevant law is the Foreign Acquisitions and Takeovers Act. So FIRB approval is mandatory for foreign investors acquiring substantial interests in Australian businesses, land or assets. The term foreign person is broadly defined to include foreign governments and their related entities, which include state-owned enterprises, importantly, foreign controlled corporations and trusts, and individuals not ordinarily resident in Australia. The threshold for review is dependent on the jurisdiction of the buyer and the nature of the asset. For free trade agreement partner investors for non-land proposals, the thresholds are actually very high, unless the investment is in a sensitive sector such as defence, telecommunications or transport. Media sector businesses has a notification threshold of $0, so everyone needs to be notified in that case. For land proposals, the thresholds are much lower than for non-land proposals. For developed commercial land, the threshold is 339 million Australian dollars. For developed commercial land that is sensitive, it's AUD 73 million, and agricultural land is AUD 15 million. Importantly, the threshold is $0 for vacant land, residential land, and mining tenements. The threshold is also $0 for foreign government investors, including SOEs. It's too much detail to discuss here, but there are higher thresholds for some of these categories for acquirers from Singapore, Malaysia, Thailand, and Vietnam, for example. And for higher thresholds, I mean it is less of a requirement for those jurisdictions.
Well, that's clear then, Ed, about the thresholds, but what does the process itself involve?
So if FIRB approval is required, it will typically be a condition of completion of a purchase agreement. So an agreement can be signed, but completion of the transaction cannot occur until approval is obtained. The purchaser needs to make a submission, which is considered by FIRB, and pay the relevant fees. And the ultimate decision rests with Treasury. There is also a national security test, which is applied to sensitive sectors, such as critical infrastructure, data, and defence. So since January 2025, FIRB has adopted a risk-based model. This distinguishes between low-risk investors, for example, repeat applicants with strong compliance records in non-sensitive sectors, e.g. commercial real estate or manufacturing, and these benefit from streamlined approvals. So the target for them is 50% of applications being processed in 30 days. Compare that with high-risk investors, including SOEs, or those investing in sensitive sectors. These face greater scrutiny, longer timelines, and more conditions. We're often asked to advise on these complex matters, as well as the more day-to-day applications.
How does FIRB compare in Australia with processes in Singapore or Malaysia, for example, Ed?
Well, it's an interesting question. So there's no FIRB equivalent in APAC. So, for example, Malaysia regulates foreign investment through sector-specific policies and requirements set by the authorities that oversee particular sectors. Singapore has sector-specific laws, but also the Significant Investments Review Act, or SIRA, which commenced in March 2024 to review significant investments in entities deemed critical to national security.
Okay. Now, the other area we wanted to talk about today was merger clearance. There are changes proposed to commence in 1 January 2026. How significant are these?
Oh, very significant. So it's worth noting also that we're in a transitional period. So these changes are impacting deal processes as we speak. It's possible to opt into the new regime now. This has been possible since 1 July 25, and the time for seeking informal clearance under the old regime, basically because of resource issues with the ACCC, has essentially run out. So deals signed in 2025, but which complete after 1 January 2026, must comply with the new regime. So these changes are the biggest changes in merger regulation in Australia for many, many years. So the key points, so all acquisitions meeting monetary or control thresholds must be notified to the ACCC and cleared before being put into effect. The transactions that proceed without clearance will be void, and penalties may also apply. So the key difference is we're moving to a mandatory notification regime where those thresholds are met rather than a voluntary one. So it's suspensory. You can't put into effect a transaction without clearance, and putting into effect a transaction is actually a lower bar than the notion of completion of a transaction. We'll come to that a bit more. So it's a move from an enforcement model to an administrative one. There are limited exemptions, for example, for some land transactions. What hasn't changed is the core test, however, so it's still the same test. So whether a merger will substantially lessen competition in a market, and there's a lot of jurisprudence on those issues and guidance. So this is known as the SLC test. Decisions are made by the ACCC or Competition Tribunal.
Is merger clearance mandatory in other ASEAN countries, for instance, Singapore and Malaysia?
No, not necessarily. So it depends on the sector. It's expected there will be a general merger control regime introduced soon in Malaysia with an SLC test. The Competition and Consumer Commission in Singapore can investigate mergers that substantially lessen competition, but there's no mandatory filing requirement.
What are the monetary thresholds for merger clearance?
Yeah, so these rules are quite complex, but essentially there are revenue tests and value tests and special rules for what are known as creeping or serial acquisitions. So the acquisition of a minority stake is caught as well if it includes control. So the threshold is met if combined Australian revenue of the buyer and seller groups is 200 million Aussie, and if the shares or assets being acquired have revenue of 50 million or more, or the global transaction value is at least 250 million based on market value or consideration received. So what this means is it'll capture many more mid-market deals than the previous regime. Now there's additional detail that needs to be considered for clients looking at these provisions, but it's probably outside the scope of this podcast. The thresholds are also met if the acquirer is large and the group has 500 million revenue and the shares or assets being acquired are 10 million or more. So these are very small deals. And for creeping acquisitions, there's a revenue threshold of only 2 million. And this is measured over 3 years. So you have to assess based on 3 years worth of deals that could be as small as 2 million revenue each.
And what about the process, Ed, that businesses need to go through?
Yeah, so it's like FIRB. So merger clearance requires submissions and the payment of the relevant fees, which in the case of the new merger clearance rules are actually quite significant. There are statutory timeframes, but these can be extended, and we expect in relation to merger clearance that timelines might be impacted by resourcing at the ACCC until everybody gets their head around how many deals need to be approved per year and what resources are required. Engagement with the ACCC is encouraged before notification. It won't be possible to sign and announce a deal and then complete once merger clearance is obtained. If clearance is required, you can't put the transaction into effect at all without clearance. It's suspended until clearance is obtained. That's an important distinction from the current regime. So the fastest decision possible is after 15 business days of the ACCC receiving the complete notification, and this is known as early phase 1 determination. And for phase 1 and phase 2 investigations, there could be additional periods of 30 and 90 business days respectively. And SOEs may face phase 2 reviews. So it's that longer period.
Given these proposed changes are very new, are we likely to see amendments before commencement?
So yeah, the changes were only announced about 18 months ago, and we're expecting more guidance on the financial thresholds in particular, and the ACCC is working with Treasury and the legal and business sectors on refinements. There might not be wholesale changes, but definitely refinements are expected between now and sort of 1 Jan, and our team will be keeping abreast of all these changes.
Anything else generally then that people need to know, Ed?
One important thing to note is the decisions will be published on an acquisitions register. Key details will be public, but not the parties' submissions themselves. The transparency of decisions and the reasoning is expected to help business and advisors.
They will build up effectively a body of jurisprudence to advise parties in the future.
Yeah, it'll be helpful guidance.
Great. Okay. Thanks very much, Ed. That was a terrific insight. Thanks also, everybody, for listening today. As always, please get in touch with us if you have any questions. You can find our details on our website, which is hallandwilcox.com.au, or connect with us on LinkedIn. And if you enjoyed today's episode, then please rate, review, or subscribe to our podcasts wherever you get your podcasts from. Thanks very much.
This podcast is not legal advice and should not be relied upon as such. You should always obtain legal advice about your specific circumstances.